Shyam Srinivasan, Manager and CEO of Federal Bank, joins us. Good morning, Shyam. Thank you very much for joining us. And let me start with the biggest pain point that the market is pointing out to. Gross NPLs have risen by 15% quarter on quarter in just 90 days. How much have fresh slippages increased?
All the 405 crores that we saw as slippages this quarter is the new slippage for the quarter. Therefore, the delta over the previous quarter that you pointed out of 15% is largely on account of some accounts that are traditionally stressed in the corporate segment have slipped. And when I say corporate, I mean credit exposures greater than 25 crores. So those were accounts that were in the restructured portfolio. If you see our GNPA plus restructured, it remains the same. What has happened is some parts of the restructured portfolio that was undergoing stress and could meet their minimum credit requirements had to be recognized as NPA, and that's what happened this quarter.
I mean, your slippages came only from your restructured book. Your standard loans or non-restructured book is not generating fresh NPLs.
Yeah, if you see the GNPA plus restructured, like I mentioned, is roughly about 7.6%, and it's been there or thereabouts for many quarters now. So it hasn't seen any significant new addition. I think in a couple of weeks back when I spoke to you guys, I did mention there are some accounts that are known and in and out. They have become out. And in some ways it's good because it gives us the potential to go out and recover the dues because most of them are well collateralized.
So you have an exposure to the Ratnagiri power plant or to Essar Steel?
No, in terms of, without getting client specific, yes, we do have two metal accounts and those are large industry-led accounts. Our share has been coming down considerably over the quarters. It's more than, we've brought it down to below 40% of what it was at its peak. But that said, we are part of these two accounts that are standard for now and needs close watch.
Okay, but your digital product Selfie that everyone was talking about, has it in any way helped increase your CASA?
Yeah, like I mentioned, the revolutionary product has given us good fillip. We've seen growth in our savings per se, and our CASA has moved to 31.67% this quarter as opposed to 30.47% the previous quarter. And this has not happened just by denominator of bulk deposits coming down. It's also happened by CASA growing, and current account has grown on an average basis 23%.
Oh, that's good. Shyam, what were your margins therefore, and how much can they improve?
3.11 for the quarter. It was 3.12 for the earlier quarter. Here I must point out two things. The full impact of the base rate reduction of the previous quarter of 25 basis points is coming through. That's about 22 crore impact. As also the impact of the unrealized income when an account slips, that has had an impact of almost 20 odd crores. So to that extent, the overall income being impacted by these two significant events has had an impact on our overall revenues. Margin for the quarter is 3.11.
Let's come to your top line now. Your net interest income is one of the big disappointments as well. It hasn't grown at all. Why is that?
Yeah, we've been more than conservative on new origination of credit for many quarters. So when we have had challenges on slippages, which largely are accounts which we have had for very long. These are not originations of more recent nature, but that said, it's in our portfolio. The happy part is most of them are out. The unfortunate part is we had to go through the pain of taking it out. But that said, the credit growth in SME is quite robust. We saw sequentially 7% growth. So annualized, we think that's about 25% growth opportunity. Our blended credit growth for the year, we're still guiding for 15% plus, and we have a very active and a tight, robust plan for our reinvigorating our corporate credit growth. We have a new ED who's come on board and a full plan that is sort of board approved as in motion. So we are a lot more confident of credit pickup in the areas we want to in the quarters ahead.
Sorry, I think I missed a number. Your credit has grown by about 4.5–5%. How much will it grow, you said, for the full year?
Yes, that's what I pointed out. We're still guiding for a 15% full year credit growth.
Yeah, sorry, go ahead. Second half?
No, by definition, second half will be good, is what I said.
Okay.
Okay. Well, DCB responded to the small and payments bank challenge by expanding its branches by 50%. Does Federal Bank see the need to do that?
See, if you've tracked us, I'm sure you have, we have 1,250 branches. That makes us fourth largest private sector bank in India, even ahead of some of the more recent banks that have merged. So I don't think ours is a footprint issue. The other banks that you mentioned have had much smaller footprint. Ours is an efficiency from what we've already sort of expanded is our crucial challenge.
Okay.
So the quarters ahead, almost 65% of our network is in semi-urban, rural and I would say non-metro locations. And that is where most of the small banks are coming in to compete. And we are reasonably well placed. On digital, I don't think we are shy of initiatives or efforts. And I think that's something that we are only accelerating into, and we believe that we can compete head to head on that front. So I am not in any fashion, I would say, intimidated by the launch. We are certainly acutely aware that there is a large team coming in with various capabilities, but we are no less.
No, that point is taken. You all can respond, Shyam, but like I was just discussing with Vibhav of IL&FS, you all can get burnt on both sides. The payment banks can take away the current and savings account, your cheap deposits, and the small banks can take away some of your small borrowers. It's ultimately your competition is increasing by 50%, 21 new guys coming in. What happens to the whole industry? Everybody's margins go down, say by 100 basis points?
Yeah, I think that is where each institution's mix and efficiencies will kick in. So if you ask us, we are not visualizing more than 10 basis point impact. The bigger impact is actually in the as passage of time, the credit competition. See, the payment banks will largely compete for the deposit business. The credit competition is what is going to drive the overall margin, I won't say shrinkage, but margin impact will play differently. So the challenge in our foreseeable future, you could take 12, 24, 36 months, is going to be on three counts. One is how efficient is the system going to be. Legacy systems do have hidden costs that we have to sort of certainly reorient, which we are doing and we are pushing very hard. Second is the adoption of technology-based offerings on a more Middle India, and Bharat has to take off on a big way. But that is no different for anybody else. So I would think these are two things. And the third is on the credit side, developing products, which is not entirely credit substitutes. And that is certainly coming.
All right. Well, thank you for joining us and talking about the numbers, and all the best for the quarters to come. That's the word from Federal Bank, still down 12.5%.